Private credit as an asset class globally is fairly nascent and new. It's only really been around since the global financial crisis, when central banks and regulators around the world, in response to what happened in the financial crisis, made it harder and more rigorous for banks to lend, enabling this asset class and market participants to grow. It is the fastest growing asset class globally, and that's all been in response to regulatory and central bank changes. It's been a little bit slower and more nascent here in Dubai because some of those dynamics have taken a little bit longer to be implemented, but also going to the reality of where Dubai is in its journey. The real estate market here is only about 25 years old. RERA as a regulator was only established in 2007, 2008. The jurisdictions such as ADGM and DIFC, the legal framework is only fairly recent. I think it's only the last 2-3 years, for example, ADGM implemented some of the framework which would enable private credit providers to offer credit in ways and forms which would give them comfort. Private credit here can't compete with local banks, but can collaborate and work alongside the local banks. And for that to take place, you needed the regulatory framework to catch up to maybe where it is globally. And a lot of steps have been taken and made by the regulators and the governments in the UAE to enable that to occur. Private credit isn't bound by central bank regulations, local banks are. So you have more flexibility and ability to do things which maybe local banks can't because they don't comply with the regulatory environment. Fundamentally, unlike a local bank, you are using investors' capital, and so the risk tolerance from those investors is higher than what a bank should be. So a bank should obviously be looking after depositors' money, and that is why it is held globally to a high regulatory standard than perhaps what the private credit industry is. That enables private credit providers to be more flexible on and competitive on terms such as LTV, covenants, making it easier for developers and asset owners to borrow potentially more money or do more creative things. The inverse of that is that means that it's the responsibility of prudent private credit providers to be much more rigorous in the underwriting of their assets and whatever it is that they're lending against, as opposed to potentially if you're a typical bank and you're relying on a balance sheet and corporate guarantees, etc. So that is the kind of like the trade-off between the two. Private credit should always work with or alongside or step into the gaps where the local banks won't or can't. So in times of, when markets are down and the banks are maybe retreating from the market, that is when private credit should be able to step in and provide solutions. And again, when the market is as buoyant as it is now, it maybe is harder for private credit to compete with the banks because, fundamentally, the cost of credit from private providers will always be higher than what the local banks will provide, at least in this jurisdiction currently. At its core, a private credit and banks will underwrite risk in the same way. It's the same skill set. You're looking at projects with the same lens, because even if a local bank might have other recourse to a parent company guarantee, for example, fundamentally it's the real estate projects that you need to underwrite. So if it's a development asset, it's the capabilities of the developer, what their track record is, what their experience is. Maybe the difference between a private credit group and a local bank is the private credit guys can do more. We can go to newer developers who don't have the track record. We can sit alongside them, overlay our experience and expertise to help them grow and kickstart their projects. We have the ability to be a bit more flexible, as opposed to going back to one of the other points around regulatory and lendings. We're not bound by the same regulations. So we can do things at earlier stages, take more risk in terms of underwriting that people will sell real estate, versus if you're a local bank, maybe you want to see the real estate sold before you will lend. So that is the competitive edge that we can do. Fundamentally, though, we are still underwriting the same risk to the same criteria. Private credit isn't getting its money from depositors who are receiving a fixed interest rate from the banks. We are getting our money from investors who will assess all asset classes to determine whether or not it makes sense for them to be giving us money to enable us to make our lending decisions. So obviously interest rate movements are an important part for us as a lender, but it's just one component. So 7-8 years ago, we would have been lending at a higher rate, even though globally rates were at zero, but we as a lender would have been lending at a higher rate than we would potentially be today, even though rates are higher, just because we feel more comfortable around the regulatory environment, the enforcement scenarios that we can take. And so we feel like we're on a risk-adjusted basis. It is now better for us than maybe it was before, even though rates have materially moved upwards. So when we as a lender are looking at everything, it is not just what rates are doing. It is the whole gamut, where the market is, how the market is performing, what the quality of the security package is, what the quality of the counterpart is, what's their experience, what's their track record. So there's multiple factors that would come into the decision. Are we senior lender? Are we mezz? Are we pref? All of those factors are probably more important than where the interest rate environment is. If interest rates are higher, it makes it harder for us as a lender to compete, because if an investor is getting 0% from his bank, he's going to want a lower return potentially from what we as a private credit provider would do. But if the banks are giving him 5-6%, because fundamentally we're illiquid, we are a higher risk than putting your money in a deposit, you will need to see the return go up. So you will be expecting as the investor a higher return. For borrowers, when they're looking to take money from private credit providers, it's typically because local banks can't give them what they want. So maybe they want mezz, maybe they want pref equity, maybe they want something different, maybe they want a higher LTV than what the banks can provide. In those instances, the cost of the capital might be a secondary factor to the primary factor, because if you can get the money cheaply, you're going to go to the local banks and provide it there. If the local banks can't give it to you and private credit can, then maybe it's a different factor, different reasons and rationales as to why you'll be going to private credit, which again is nothing really to do with the interest rate. As the industry matures globally, and Mashreq as a good example, they have provided capital to private credit providers globally. So they will come in alongside big private equity firms in the US and in the UK, and they've been very active in that space. Local banks have yet to do that in any material way here in the region. That is obviously, if they start to get comfortable in understanding the benefit of private credit and what they can do, that would materially help borrowers and lenders, be it private credit or banks, be able to provide more flexible capital solutions. If you can get the benefit of what the local banks can deliver in terms of scale and pricing, and the private credit guys can top up on top of that, you're going to be able to provide borrowers much more flexibility than maybe can occur if it's just the local banks competing on one side and the private credit guys trying to compete on the other side. That becomes a bit more complicated and difficult, and globally, the private credit providers and why the industry is growing so quickly is they are seen as a one-stop shop for the borrowers. So they will go to the private credit firms. The private credit firms behind the scene will secure their leverage from the banks and be able to provide a material amount of capital on very competitive terms. That is what is happening in Europe and the US. I think with creative and smart banks such as Mashreq, that can start to happen here in the UAE. And when that starts to happen, you will be able to see a material upsides in the amount of private credit that is provided, because you're not then just being forced to wait for down markets when you can get really involved, or limiting yourself in up markets like now to growth capital, mezz, second lien, pref equity, which is always a fairly small amount of the pie of what we would be wanting to do. And it's also not as good for the borrowers, because if we are able to work currently with a local bank, it would typically be two facilities. It's a lot more complicated. Sharing security is a lot more complicated and a lot more difficult than what the precedents are now globally in this space. So if people are approaching private credit with a mindset that they're going to be competitive on terms as what a local bank can do, and they haven't gone to local banks first, then they should probably start with the local banks and find out where they are. If they have gone to local banks and they're coming because they know that we can do better in terms of security package or lend more money, they need to accept and understand that with that comes enhanced risk and underwriting on the asset. So there will be materially more work done on the underwrite, making sure that everything is stacked up, and they need to be prepared for that process. If a local bank is lending and there's a full comprehensive security package, including parent company guarantees or personal guarantees, private credit providers don't necessarily need that. Sometimes they will take that. But if they're not doing that, they're not getting those extra guarantees, then they're going to be hyper-focused on what the asset that they're lending can deliver and what the security package is for that, because that is their only recourse if something goes wrong, to be able to enforce against that asset as opposed to relying on protection from a parent company. You need to go to the private credit provider with a very clear and simple ask. If it's you want to go buy additional land, you have a great project, it's under construction, there's money coming, maybe it's tied in escrow accounts, and you want someone who has the flexibility to underwrite that risk and enable you to provide capital to acquire more projects. That is a very simple thing, and that is what private credit providers want to do in an environment like this, because it's more growth equity, it's helping developers grow. as opposed to just taking security over one thing. But go there understanding that the security package across everything is going to be completely comprehensive. It's not an easy touch, it's not an easy solution, because your underwriting and your risk tolerance is all around the assets that you're financing. And so therefore, you as a lender need to be incredibly comfortable with the underwrite that you have done to make sure that you feel comfortable with the risk reward that you're going to be getting in return for giving that money to the developer. You, as the lender, are never becoming the developer. You never want to step into the shoes of the developer, but you need the ability to do that if things don't go well. And so you as the private credit guy group will always be focused on that underwrite and being prepared to, if things have gone wrong and you're not getting your money back, being able to step into the shoes of the developer to do that. And that dynamic is always the most important thing in my mind as to what a borrower should be prepared for before they approach private credit, because unlike a local bank where there may be other recourses, other guarantees, maybe that doesn't typically apply in a private credit solution. So my advice would be to be transparent and flexible from the outset, understand what you're asking the private credit group to provide, and acknowledge that they're not local banks. Don't go in there with expectations that they're going to compete with local banks. That is not the role of private credit in this marketplace.